Hello and welcome to the Bankers Brexit podcast series. Today I am joined by Stefanie Linhardt, our Europe editor, and James King, our Middle East and Africa editor. I am Stefania Palma, the Asia editor of The Banker. And today we will be discussing the impact of Brexit so far on the different regions that we cover. So I think it might make sense to start off with Steph, since she covers Europe. When we look at the banking sectors, both in the UK and Central Eastern Europe, which is a region that you travel to extensively, what have been the impacts so far?
Well, obviously, there have been significant impacts in the whole region. Europe is very much impacted by all of this. In the UK, we've seen the Bank of England already shelve the introduction of counter-cyclical risk buffers, which were initially planned to be introduced in March next year. This basically results in a net reduction in the UK banks' capital requirements. So this will be very helpful for the banks because they will be able to use this money to lend it to the economy. And they have, with the then still Chancellor, Osborne, also agreed that they will bring this money to the economy. In Central Eastern Europe, meanwhile, I've spoken to some banks and they have said that this legislative environment that has been at times a bit difficult. We've written a cover story on that in the August edition. Banks have been faced with a few levies and some difficulties. It seems like some governments are slightly retreating from this more confrontational stance and might be softening.
And we're talking about local regulation in Central and Eastern Europe.
Local legislation.
Perfect. And if we look at the monetary policy angle, how do you think this has evolved since the referendum vote?
Yeah, so there has been this expectation that the Bank of England would slash the interest rate to zero at some point. This has not happened yet. And one of the Bank of England policymakers, Martin Wheel, only just suggested that also in August there will not be a cut in the interest rate to zero. In the region itself, there is an expectation that the monetary easing that has been going on will carry on for longer. And we've already seen that Sweden's Riksbank, for example, has postponed a decision to increase interest rates.
Perfect. And James, if we had to move on to Africa, we've been discussing and you were pointing out that actually the biggest effects are more on the trade and investment front. So how is the picture there?
So I guess in overall terms, sub-Saharan Africa is relatively less impacted by Brexit than other regions. But looking sort of ahead to the medium term, what we'll see is perhaps some economies in the region taking a hit in terms of their exports to the UK if the UK economy is going to cool down. We'll see countries like Mauritius, who export about 14% of their total goods to the UK, take a hit from that. Also, we'll see on the investment front, issues around sort of investor perceptions of risk, particularly in the UK. So around 30% of UK FDI into Africa goes to South Africa. That could begin to cool if the UK economy also slows down. And also there are issues around sort of tourism as well. So given the weaker pound, we might see UK tourist numbers to the region begin to drop off as well. And the key markets there are South Africa, Kenya and Mauritius as well.
That rely heavily on tourism.
Exactly.
Whereas I found quite interesting that for the Middle East, it's actually more a case of Middle East investors looking to the UK now that a new Prime Minister, Theresa May, is in office, and there's a bit of doubt as to, in terms of policy, what this might mean.
Right, exactly. So Theresa May is something of an unknown quantity in some respects. We're still not really sure sort of what her policy priorities are and what really her kind of worldview is as well in some respects. So I think that'll take some time to sort of pan out. But, if the government was to adopt perhaps a more sort of isolationist or conservative approach to sort of the UK's policy environment, we might see things like property tax hikes be phased in. We might see changes to expatriate buying laws for property and so on. And that would obviously have an adverse impact on sort of Gulf flows into the UK, so sovereign wealth funds and private buyers looking at the UK property market, for example. That could be offset, however, by obviously the weaker pound, making the UK a more attractive kind of investment proposition. So there are two kind of balancing factors there. But I guess on that issue of kind of currency movements, when you look at Asia, that's obviously a very interesting time right now. We're seeing a lot of volatility there. How much would you sort of tie that into what's happened with Brexit?
So I think in terms of the Asian region, the currency move is something that is probably the key consequence and the key effect that Brexit has had on the region. It's not so much about trade and investment as in the Middle East or Africa case, because there's a very low exposure to the UK. I think collectively around only 1% of GDP across the region is exposed to the UK. Even I think only Singapore has about 2% of GDP that's in terms of trade flow with the UK. The currencies, however, have moved a lot. The yen is what really stands out. It has appreciated even just the day after the referendum past the 100 yen to the dollar mark. At the moment, it is at about 106. This is quite a high level and makes institutions in Japan quite nervous, because it means that exports are less competitive. And this is quite worrying in a country where that is really trying to boost its economy. It's grappling with deflation, and it really does not have that much more room in terms of easing monetary policy, because they're already in negative interest rates territory. What is also interesting to note, on the opposite end of the spectrum is the Chinese renminbi, and some analysts argue that Chinese institutions are jumping on this bandwagon of Western currency volatility to let the renminbi fall versus sterling and euro. Obviously, the renminbi is not a freely floating currency; it moves within a band. But essentially, what the central bank has done is it has moved the midpoint of this band to some of the lowest levels since 2010. So this is guiding the currency to weaken further, and it's always been a contentious point geopolitically, because it makes Chinese exports very cheap versus the rest of the world.
Well, if we look a bit at the macro side of things as well, in Asia, what might this Brexit mean for the Asian sovereigns that are dependent on external financing?
So that's actually quite an interesting point, because if there is increased market volatility, it could affect these countries that do depend on external financing. And two of the ones that depend on this the most are Mongolia and Sri Lanka, and they're already doing quite poorly, especially when it comes to current account deficits and balance of payments crises. They both faced large redemptions in 2016 when it comes to sovereign debt, and both of these countries have already taken out IMF loans in 2009. Mongolia asked for IMF support last year, and Sri Lanka just basically agreed to a $1.5 billion IMF loan this year to avoid a balance of payment crisis. So if we do see volatility grow further, this might really hit the weakest economies in Asia. So I think that with this run around the world, we really looked at different perspectives on the effects of the Brexit referendum on different regions. We will be discussing this further in different angles of the financial markets with our Brexit podcast series. Thank you very much.
Thank you.